Uranium, of course, has been for some time in a deficit. It could afford to be in a deficit because we overproduced so much in the last boom. And then the floor in demand fell out with Fukushima. But there's widespread political support in Japan now for restarting the Japanese nuclear fleet, and that's beginning to happen. That's important for two reasons. It increases the demand for uranium, but more importantly, it takes the most important source of supply, that is to say, inventories that Japanese reactors had held but weren't using, off the market. So I would say we're actually in a real bull market. I say it's a stealth bull market because nobody's noticed.
Hello and welcome to Capital Cosmos, everybody. Today I have a very special guest that most likely does not need an introduction, but I will give him one nonetheless. It is Mr. Rick Rule. Rick, thank you for coming on the show, my friend.
A pleasure. Thank you for giving me the opportunity.
Well, before we get started, though, neither Rick nor I are financial advisors, so please do your own due diligence. It's your money, your responsibility. And if you enjoy this kind of content with these type of guests, be sure to subscribe to the channel, hit the like button, comment down below, do all the YouTube stuff I'm supposed to tell you to do. With that said, Rick, go ahead and tell us who you are for those who may not know who you are.
Well, I guess the most accurate description of me is a semi-retired investor and speculator. I've been 49 years in capital markets, mostly around natural resources, but also conventional services. I've built and sold a couple of financial services businesses. I failed retirement completely. You may know I'm starting a new bank, Battle Bank. And in addition to that, I have an information business called Rule Investment Media that, among other things, sponsors virtual and live conferences and has done so for 28 years.
Excellent. Well, let's just jump right into it then. How does Rick Rule evaluate companies? This is something I've heard you talk about in the past, but I think it's important for my audience to kind of understand what are some of the things that you look for.
Well, I think in a very broad sense, I look for value. Too many resource investors, I think, are narrative oriented. They hop on the latest, best thing. They hop on what they think is the most exciting story. At age 70, I don't have much need for excitement. I've had plenty of it in my life. I'm trying to make some money. So the consequence of that is that I look for the juxtaposition between price and value. I note, too, importantly, the concept of Pareto's law, the fact that competence and performance is not conformably dispersed among humankind, but rather segregated very determinedly. You will have heard the dictum, the 80-20 rule, which suggests that 80% of the utility is accomplished by 20% of the population in any given task. It's important to note that it's a bell-shaped curve. So there's a good lip, that is the performing 20, and there's a bad lip, the offending 20. So your first job is to hang out with the good 20 and avoid the bad 20 like the plague. After a couple of years, you learn that both the good lip and the bad lip, if run through the same performance dispersal curve, will conform consistently, which is to say that 20% of the 20 do 80% of the 80, or 4% of the population generates 65% of utility. So in addition to value, you look for proven performers whose resumes are tasked, particularly the task at hand. Finally, I think you look for rationality. Building wealth in exploration or in junior extractive industries is very similar, really, to doing the same thing in technology. You look at unanswered questions that will improve the market's knowledge about the ultimate success or failure of the task at hand. If you understand that analyzing junior resource companies is really a function of asking what the most important unanswered questions are, what they're worth, what the probability of success is, how long it will take you to get a yes answer, and what next question that yes answer might propose. If you do that and you constrain your investment choices to companies that are run by competent people with experience at the task at hand, you will do well. If you don't, you likely won't. I should also add, it can really accelerate your success or failure by being a contrarian. If the hottest thing at the moment is uranium, avoid uranium. Go to the coldest thing, and understand that making a lot of money requires compounding. Compounding requires time. Profiting from time requires patience.
Right. So how do you measure whether something's hot or not? Do you I've never heard you talk about technical analysis. Do you employ any technical analysis? And so
I do not. It's sort of a gut instinct. The best illustration I can give was in going all the way back now to 1998. It was very clear to me statistically that $10 a pound uranium couldn't stay. It cost the industry $30 a pound to make the stuff. So they were making the stuff for 30, selling for 10, and being miners trying to make it up on volume. That wasn't going to work. There were 5 companies in the world, junior companies, that have survived a 20-year bear market in uranium. It's pretty clear that it wasn't a crowded trade. But better yet, when I get on the podium and talk about uranium, people weren't merely bored, they were hostile. They said I was trying to profit from Chernobyl and Nagasaki and 3 Mile Island. But, 20% of the world's baseload power came from uranium. It was very clear to me that either the price went up, the price would go up, or the lights would go out. 7 or 8 years later, the price had gone from $10 a pound to $140 a pound. Nobody cared when the price had to go up, and everybody cared when the price had to go down. The number of companies that were looking for uranium ballooned from 5 to 500, not a typo. At the beginning of the exercise, there were probably 12 or 15 teams capable of running uranium junior worldwide. When there were only 5 junior uranium companies, the probability that your company had an adequate team was a function of dividing the number of teams available, which is to say 15, by the number of aspirants, which is to say 5. When uranium was popular, the equation was less attractive. Again, divide the number of teams, 15, by the number of aspirants, 500. Which meant that the probability that your uranium junior had a qualified team running it was running somewhere around 3%. Very, very, very bad idea. So another wonderful example, if you roll the clock back, 3 years ago, was when the price of oil went briefly sub-zero. You had that noted energy physicist, Greta Thunberg, saying, with the help of other big thinkers, Justin Trudeau, Joe Biden, the sort of, how would you say, the moronic successors to the Club of Rome, that the world was going to be off of fossil fuels in 2030. In addition, you had fossil fuel demand reduced by COVID. And the price of oil went briefly sub-zero before settling at about $20. Now, the International Energy Agency has said that the fully loaded cost to produce a barrel of oil, including social rents, cost of capital, taxation, prior years' failed efforts, is around $60 a barrel. So the industry is making the stuff for 60, selling it for 20. Deciding whether or not the oil price is going to go up is a simple function of asking yourself, will my car start in 5 years? If you believe that when you go out to the garage and turn your key to the right, that the car is going to start, assuming you don't have one of these push-button cars, you believe that the price of oil is going to go high enough that the industry can make an acceptable return on capital employed. That's how I do it. It has nothing for me to do with technical analysis. I love sectors where demand for the product is assured because of its contribution, its utility to humankind, where the price of the product is less than the cost of production. I love industries in liquidation because it means that the price has to go up. That's the sort of certainty that I love.
Yeah. So to kind of wrap it all together, essentially, assets or sectors that are essential and critical for the functioning of society that are both at the same time well below their cost curve.
Yeah, well below it, the cost curve and the incentive price. Absolutely. Right. Those are inevitable. Now, a lot of speculators want instant gratification. They have trauma holding stock over a long weekend. Warren Buffett famously said that the market is a very efficient mechanism for transferring wealth from the impatient to the patient. I've tried to be patient.
Yeah, I don't know if you've seen this stat, but the average time duration of a stock held went from, I think, 10 years in the 1960s to like less than, like a few months, less than a year to today. Like, so the patience within the average investor has gone down substantially. And that's one of the things I try to tell people on this channel. You could use patience as an edge in this case.
Patience is an edge. You have to know enough about your investments that you can stomach the volatility. And you have to know enough about your investments that you regard share price declines as sales, not as tragedies. If you know a company very well and you decide it's cheap at $1, if a consequence that's unrelated to the company, say market conditions or sentiment, is such that stock that you thought was good value is at 50 cents, that's not the right time to sell. It's the right time to buy. I'll give your listeners an interesting factoid. We back-tested most of my successful speculations going back 40 years, testing my memory a bit, by the way. And I learned that on those companies where I was lucky enough to score a 10-bagger or better, 1,000% return, the average holding period for that 1,000% return exceeded 5 years. And almost every 10-bagger, but certainly every 20-bagger that I enjoyed, subjected me to a 50% share price decline during at least one part of the period where I held the stock. So if you aren't willing to do the work to give you the confidence to understand value, you need to speculate less and invest more.
Yeah, conviction is another edge.
Yep.
So,
and I think knowledge is the foundation of conviction.
100%. So what do you do, for example, when you have like a basket of stocks and you want to deploy capital, but then you've got to choose between a stock or a sector that's down, call it 30, 40, 50% versus one that's best performing? Is it always best practice to add more into the least performing stock, or do you want to kind of pump more fuel into your winners as well?
With me, it's always about relative value. I pay real attention to the juxtaposition between what I think something is worth and what it's selling for, with the understanding that I'll never get it right. I just need to get it relatively right. And it also depends on my own needs as an investor. One of the things that I've learned in 49 years in this sector is that market beta, I would define beta as the difference between, say, a certain sector and the market as a whole. Market beta in natural resources is extraordinary. You don't need to take exorbitant risk to buy the best stock in the sector when the sector as a whole can give you a triple. You just have to have the guts, the patience, and the knowledge to invest in the sector when it's out of favor. So at age 70, not willing any longer to work 80 or 85 hours a week, I notice, as an example, that in the uranium sector, I own more Cameco and more Kazatomprom than I would have when I was 40, because I'm less willing to slug through 85 uranium juniors to try and outperform the uranium market when I believe that the uranium market as a whole is going to give me a triple. I don't know when the uranium market is going to give me a triple. So as an example, the dividend yield on Kazatomprom frees me from the time value of money conundrum and allows me to participate in market beta. Now, I do try to find the best of the best uranium juniors. I'm not sure why I do that anymore, other than the fact that I like it. And also, frankly, because all of the money that I now invest prudently, I made by speculating wildly.
Can't help yourself, can you, Rick?
I can't.
So let's hop on to uranium now that we've kind of touched upon it. Price is sitting at $58 at the moment. You've said that uranium is in a stealth bull market in other interviews. Can you explain what you mean by that?
Well, yeah, first of all, in the spot market, the price is up 20-something% this year. If you look at the rest of the commodities complex, uranium and coal, and to a lesser extent oil, but not natural gas, have been the performers. Lithium, too. But it's a stealth bull market. The price of uranium has gone up, but with the exception of Cameco and perhaps NextGen, the price of the uranium equities has not gone up. But I think what's important for investors to understand is that the structure of the uranium market has changed. 3 or 4 years ago, most of the trades in the uranium market took place in the spot market. Now, 75 or 80% of the volume is taking place in the term market. And the term market is very opaque. You can't have that same day-to-day reference that you have in the spot market. The term market is a contract between 5 and 15 years that provides pricing stability to both the user and the producer. It's useful for the producers in the sense that it is contractual and much less volatile than the term market. And provided that the counterparty to the term is creditworthy, that contract can be used to finance a project into production, as an example. So the undertone of the market is much stronger than is suggested by the spot market, because the term market at present is trading 12 or 15% higher than the spot market, giving producers higher near-term cash flows in return for moderating the price upside expectations that they might enjoy. Uranium, of course, has been for some time in a deficit. It could afford to be in a deficit because we overproduced so much in the last boom. And then the floor in demand fell out with Fukushima. But there's widespread political support in Japan now for restarting the Japanese nuclear fleet, and that's beginning to happen. That's important for 2 reasons. It increases the demand for uranium, but more importantly, it takes the most important source of supply, that is to say, inventories that Japanese reactors had held but weren't using, off the market. So I would say we're actually in a real bull market. I say it's a stealth bull market because nobody's noticed. There are other anecdotal things. The discount to net asset value enjoyed by the Sprott Physical Uranium Trust 6 months ago, 7 months ago, that trust was selling at a 14% discount to NAV, which is saying that you could buy uranium through the Sprott Physical Uranium Trust at a 14% discount to NAV in a commodity where the price had to go up.
Yeah,
that discount's evaporated. The discount to NAV now is 1.5%. So in that sense, we are in a stealth bull market. People have begun to see that the uranium price has to go up, and as a consequence of that, a physical trust whose only asset is physical uranium selling at a discount to NAV is stupid. And that stupidity and that discount is being eliminated in the market.
Yeah, and if you look at Sput's purchasing history of uranium over the last 2 years, you'll notice that anytime the huge jump in uranium price and the spot price is tied directly to when Sput's buying. Except for most recently, the last several months, Sput's been in negative discount to NAV territory. But yet, to your point, the uranium price has been continuing to grow, up 20% year to date. So this kind of marks a kind of unprecedented, at very least in the short term.
Yeah, a couple comments there. The first is that we're back into an inventory pricing cycle. That is to say that a lot of nuclear fuel users were relying on the spot market for inventories. The users see the same thing that I'm seeing, which is to say the arithmetic of tighter uranium supplies and higher prices in the future. And this fueling cycle and the disintermediation from spot to term in terms of fueling has been important. The second thing that's been important is simply Sput itself. You have an entity that took 50 or 55 million pounds of uranium off the market, sent it to uranium heaven. This fuel would have been regarded as held for sale, which is to say it would have been supply, but it's not held for sale. The Spot Physical Uranium Trust has no sales mechanism. If uranium ever got tight enough and users needed that uranium and bid the shareholders a premium to the trust. It might be that the trust would be liquidated and the proceeds distributed to shareholders, but that's highly speculative. Right now, 55 million pounds of supply is no longer supply. It went to supply heaven. And I think that's exacerbated the tightness. In a market that is already very tight, to the extent that the SPUT vehicle goes to a premium and begins buying uranium again, you may see a return to the cycle that you saw in 2020, which is to say a very, very, very bullish short-term swing in the uranium price. I'm not saying it's going to happen, but I watched it happen once before. And certainly all of the conditions precedent seem to be in place for it to happen again.
Right. So I actually have the total uranium miners market cap sitting at 46 billion from what I can see here. But what's interesting, Cameco sitting at 15 billion, 15.7 billion, Kazatomprom's at 8 billion. So let's just call it half of the total uranium market cap is consolidated between two big companies. That leaves the other half, the other 23 billion, just spread across these small equities. Another thing that's interesting is that Cameco is at around the same market cap level as it was, I think 2007, 2008. So what is it essentially telling us that could we potentially go even higher than the $150 billion market cap that was set in 07, 08?
If you give me the use of the word potentially, of course. Understand that Cameco and Kazatomprom have this wonderful advantage over the rest of the space. They make money.
Yeah, the cash flow. No.
Yeah, the other 50% of the market cap, if you merge them all, probably lose $500 million a year. So, other than anticipation of higher prices, which is to say optionality, or in anticipation of those few projects that have to be bought, I'm thinking about next-gen fission as an example. The rest of the industry is a speculation on either higher uranium prices, successful exploration, or successful development. I suspect that the most immediate beneficiaries of high uranium prices will be somebody that has uranium to sell, which is to say Cameco and Kazatomprom. The other people hope to have uranium to sell, which is a different set of circumstances. Now, I'm not saying, by the way, don't speculate in them. My greatest hit in the uranium business was Paladin, which was certainly a penny dreadful explorer. I'm not saying don't do it. I'm saying that the segregation in market cap is rational.
So how do you
there's more investment money available for uranium right now than speculative money.
Yeah, 100%. How do you position size though? Comparing more something that's more of an investment like Kazatomprom or Cameco versus the other juniors out there. Do you have any hard and fast rules that you go by in terms of I'm not going to allocate more than 10% or 5% to a company or something like that?
No, I don't. I don't have anything that's artificial like that. I juxtapose my own wants and needs and prejudices against my perception of relative value. I will say at age 70, and this is going to sound very hubris-ridden, but I don't need to speculate to get rich because I'm rich. That's done. And I recognize from the last bull market in uranium that the market beta really gives me all I need. I'm doing the alpha to amuse myself. I think uranium's going to go up. So the first way I play it, the lowest risk way I play it, is I own SPUT. If you think the commodity is going to go up, the baseline is buy the commodity. Don't take the company risk. Don't take the balance sheet risk. So I own a reasonable position in the Sprott Physical Uranium Trust. Listeners, by the way, I'm the largest shareholder of Sprott. If you buy the Sprott Physical Uranium Trust and it goes up and its NAV increases, the management fees increase, and hopefully my shares of Sprott go up. Discussion of conflict of interest. The best uranium company in the world, bar none, is Kazatomprom, but there are challenges that people have holding it, given that it's in a country that most people can't spell or pronounce and can't find on the map. So I own a reasonable sum of Kazatomprom because I'm more comfortable with political risk than most people are. My third largest holding is Cameco, because I think that Cameco will reflect market beta more fully and more directly than any other company in the space. There are, at last count, almost 80 uranium juniors out there. At 70, I don't count as well as I once did, so there might be more. And I figure somewhere between 8 and 11 of those are buyable. The rest of them, until I get better data, fall sort of into the lame, the halt, and the blind category, which I don't own. I should say, too, I'm less concerned now about technical successes around small mines. I've learned in my life that small mines have as many risks as big mines, but small mines can never make you big money. So if we're not talking about a junior with a valid target that exceeds 100 million pounds, I don't want to know, even if there's a high probability of technical and commercial success. I want to be involved in projects with, sort of $5 billion in recoverable in situ reserves and resources that will, if my estimate about them is correct, end up being in the best quartile worldwide in terms of all-in sustaining costs, and the best quartile worldwide, too, in return on capital employed. I care less about somebody who has a 20 million pound deposit that will likely be placed into production, that will deliver $80 million a year in revenue and $20 million a year in free cash flow. I kind of don't care about that. The small business part of my own portfolio is invested in community bank stocks, which are roundly hated and superior businesses. So for the small business part of my portfolio, I'm all in on community bank stocks.
Interesting. I want to kind of take it back to something you said about Kazatomprom. You don't the geopolitical risk doesn't bother you as much to stop you from investing in Kazakhstan through Kazatomprom. One thing I want to bring out is this was just reported, a third of all U.S. consumed uranium last year came from Russia.
That's right. And I'm not arguing that Russia or Kazakhstan are good political jurisdictions. I'm arguing that every political jurisdiction I've ever been confronted with in my life is shitty. The biggest loss experience I ever had in political risk was with the Viceroy mine in the People's Republic of California. I believe that the most dangerous amalgam of politicians is the ones that's closest to you. Is British Columbia good jurisdiction? It's horrific. Is California good jurisdiction? It's horrific. I have enjoyed over time better results in Chile than anywhere else in the world, but the Chilean voters now are choosing to snatch defeat from the jaws of victory. And if you look at a jurisdiction where you really took risk in terms of money in, money out, the best performer in my portfolio has been Congo. I was investing in Congo when there was a civil war there. 2 million people died directly. They had AIDS, Ebola, warlords, malaria. Was it a good country? No. It was a country with a marvelous endowment where the perception of the political risk was even more horrendous than the actual political risk was. But the important part of the discussion is that there is no good jurisdiction. People who are comfortable in the United States, sort of red meat, flag waving Americans, if you're in extractive industries and you are not in Nevada, Texas, Wyoming, or Alaska, you are running way more political risk than you think you are.
Yeah. And glad you brought up the Congo and just this entire topic of geopolitical risk. I want to get your thoughts on this, some of the things that are going on in Niger. If Niger kind of falls into the Russian sphere of influence, that would kind of put Russia with about 60% of all uranium supply. If you spread it across Russia, Kazakhstan, Uzbekistan, and then Niger altogether, it's about 60% of total uranium supply. What does that spell in terms of the uranium spot market?
Nothing. except that the spot market is driven by narrative. Niger produces just under 4% of the world's supply of uranium. It's an important producer for France. If, for argument's sake, Niger began to be diverted from France to, let's say, China, then Australian production, which is going to China, will be diverted from China to France. What we've seen with the sanctions on Russia is that for many commodities, sanctions don't work. Russian natural gas, Russian oil that used to go from Russia to Germany now goes from Russia to Germany by way of India, where it's refined and transshipped. The truth is that demand for these commodities are fungible. I think investors make a mistake too when they think that countries have friends. They don't. Their leaders and their elites have interests. I think it's fair to say that France has overstayed its welcome and overcharged for whatever it purported to do for French West Africa, including printing the currency and enjoying the seigniorage. I think what you're seeing in Niger is not so much an independence movement, but rather a change of elites. And I think that the coup leaders will become closer to Russia because Russia will send them reliable Russian bodyguards armed with guns that don't care anything about ethnic clashes in Niger and are loyal to the elites that serve Russian interests. Now, the Russians aren't doing anything that the United States didn't do in the 1950s, 1960s, and 1970s. The Russians and the Chinese are taking an American and European playbook and updating it. While we lecture people in Niger about gender equity and things like that, the Russians say, if you give us preferential trade treatment, we will kill potential usurpers. It's precisely the deal that Americans made with the Saudis, as an example, going back in time. So it's important to put all of this stuff in context.
Right. Before we kind of get off the topic of uranium, this is a question you get all the time. What inning are we in?
I don't know. I mean, let's be honest about that. I don't know. I suspect we're, if it's going to go 9 innings, if it's not going to go extra innings, I suspect we're in the 3rd or the 4th inning. Let's ask the question differently. It is believed that the all-in, and I don't mean AISC, but the real total cost to produce uranium is about $60 US a pound. That includes cost of capital. The idea that AISC doesn't include cost of capital and doesn't include tax and social rent makes it a pretty stupid number. If you add back prior year write-downs, which were a cost in current production, the cost of capital and social rents, the price necessary to maintain current production is about $60 a pound. If, however, you look at incentive price, which is to say the price that is necessary to erase the production deficit that exists in the market today, the incentive price is much closer to $75 or $80 a pound. If you saw an $80 a pound price in uranium, which I'm highly certain that we'll see in real, not nominal terms, in the next 5 years, what you would see is that the free cash flow around companies like Cameco and Kazatomprom would at least triple. But more importantly, what you'll see is that rock in their inventory, which is treated as marginal now, would become reserve and resource. So you get a wonderful double bump. That's not a way, by the way, of avoiding your question. It's just a way of illustrating the way I think, which doesn't go so much to innings or rules of thumb, and much more to arithmetic and economics.
Right. Here's another common one I get asked as well. Will we? Well, do you think that we will retrace back up to the $140 highs in the spot market,
I
even
think
though
I
that
think
price
we
isn't
could.
necessarily inflation adjusted?
I think we could. I don't think we need to, because I think the Kazakhs have the ability to ramp up production fairly substantially.
Mm-hmm.
I think it's important to note, though, that $140 number was achieved in 2011. And the value of the denominator, which is to say the US dollar, the purchasing power of the US dollar, is substantially lower than it was then. So 140 may very well equate to some number like 110 or 115 in constant dollar terms. At the same time that the real price of the commodity, in effect, has been declining, the real costs of putting projects into production, including the cost of capital with higher interest rates, is higher. And so when people congratulate themselves on achieving $125 or $140, they need to understand that victory occurred in nominal terms.
Right.
What I think is possible is that the incredible investment that the industry made in the period sort of 2005 to 2011, 2012, may have the ability for some companies of lowering their structural costs substantially over time, which is to say the margins that they achieve as the price goes up may be better than the margins they would have achieved before.
Got it. Do you see any other sector that you're more bullish on than uranium at the moment?
Not that I'm, well, one example, one exception is very, very, very tough to play.